Welcome to Financial Literacy for Not-for-Profit Directors. In this video, we will examine the balance sheet. The balance sheet presents a snapshot of an organisation's assets, liabilities and equity at a particular point in time and is designed to show what an entity is worth. Its formal name is the Statement of Financial Position. The balance sheet is an aggregated listing of all the assets and resources owned or controlled by the organisation, and a listing of all the liabilities and obligations it owes to others at a specific point in time. It represents the state of the company's financial position or health and accumulates this information from one reporting period to the next. That is, if the organisation ends a period with cash of $10,000, then it also starts the next period with $10,000. As the statement is a snapshot in time, it is necessary to compare the results over a number of periods to get a sense of the trend of what is happening. The balance sheet consists of assets, liabilities, and equity. Let's take a look at assets. Simply put, assets are what the entity owns and uses to generate its goods or services. Assets are split into current assets and non-current assets. Total assets equals current assets plus non-current assets. Current assets are expected to be converted to cash, used, consumed or sold within 12 months from the date of the balance sheet. Current assets include cash, receivables, grants received in advance, inventory or stock, prepayments of expenses. Non-current assets are those which are not classified as current assets. In other words, it is expected the entity will continue to have the asset for longer than 12 months from the balance sheet date. Non-current assets generally include investments, plant, property and equipment, intangibles, for example, like goodwill. When you look at the assets in the balance sheet, what should you consider? How easily do the assets cover the liabilities? This will identify the risk to the organisation of becoming insolvent. How liquid are the assets? In other words, how easily can they be converted to cash? Have any asset values been impaired? This means the market price of an asset is less than the balance sheet price of an asset. Are there any assets that could be sold to free up cash? You should question the existence of the assets. Do they really exist? Ask to see them. Do you need to conduct a stock take to ensure the inventory actually exists? Does the plant and equipment in the building or on site match the asset register? When you look at assets in the balance sheet, you should consider the control or the ownership of the asset. Who owns the asset? Does the NFP own it? Can you sell the asset? You may have the use of it, but you may not be able to sell it. When looking at the assets, you should also consider the value. What value is recorded on the balance sheet for a particular asset? Has the asset value been impaired? That means, is its market value less than what is recorded on the balance sheet? What is the market value of the asset if you wanted to sell it? Assets are not allowed to remain on the balance sheet overvalued. Therefore, they must be revalued. And if they have been revalued, was an independent valuation conducted? Liabilities. Simply put, liabilities are what the entity owes. They may require cash to be paid or a service to be fulfilled. Liabilities are split into current liabilities and non-current liabilities. Total liabilities equals current liabilities plus non-current liabilities. Like assets, a current liability is an obligation the entity is expected to pay or settle within 12 months from the date of the balance sheet. Current liabilities include payables, short-term borrowings, or provisions, for example, annual leave, superannuation payable. And just like assets, non-current liabilities are those liabilities not classified as current liabilities. In other words, the obligation is not due until after 12 months from the balance sheet date. Non-current liabilities include longer-term borrowings and provisions, for example, long service leave. When reviewing the liabilities in the balance sheet, the following things should be considered. Are all the debts recorded on the balance sheet? Is the timing of when debts need to be paid or fulfilled understood? Are the accrual adjustments that have been made understood? For example, provisions for employee entitlements? When does the organisation start to accrue long service leave? This is a very important issue, especially if the organisation acquits grants to funding bodies, as all costs to deliver a program must be acquitted in the year it is incurred. Like the assets, the value of the liabilities should be questioned. What value is recorded? Are all the accounts payable recorded? Are all the debts being paid on time? Are there any liabilities that are payable in years to come? What value has been recorded in the balance sheet? Can it be brought to account at its discounted present value? Does the organisation have any contingent liabilities? A contingent liability does not appear on the balance sheet, but are included as a note to the financial statements. The organisation will need to plan how they will cover the liability if it eventuates. The most common type of contingent liability is a filed unsettled lawsuit. Net assets is simply total assets less total liabilities. Equity represents the asset value that would be left over for the members of the organisation if all the liabilities were paid out. It also represents the organisation's safety margin, that is, the extent to which the total assets cover the total liabilities. Equity is split into contributing equity, reserves, and retained profits. When looking at the equity in a balance sheet, is it growing or shrinking? It will grow with profits and shrink with losses. Does the organisation have a policy about the level of equity it must maintain? For example, enough equity to cover 6 or 12 months operating costs. That concludes the video on the balance sheet. Thank you for watching.